With the markets doing what they're doing, it can feel a little overwhelming to think about investing. That's why we're here, to cut through all of that noise. We're going to lay out a really clear, evidence-based plan for making calm financial decisions, no matter what the headlines are saying. You've probably heard this quote before, and for good reason. It's a powerful reminder that trying to outsmart or predict the market is, well, it's a game that most people end up losing. So if we can't count on the market to be rational, what's the rational approach for us? Right. If timing the market doesn't really work, and just letting your cash sit there means you're losing money to inflation, what's the actual path forward? Well, the good news is there is a proven strategy, and it starts somewhere most people don't even think to look. So, before you even think about buying a single stock or an ETF, you've got to get your own financial house in order. Seriously, this is the non-negotiable first step. It's what lets you invest with confidence instead of with fear. Before a single dollar goes into the market, there are two things that just have to be handled. First, any high-interest debt. We're talking mainly about credit cards here. Second, you need an emergency fund that can cover 3 to 6 months of your essential living expenses. Think of this as your financial firewall. It's what protects you from being forced to sell your investments at the worst possible time just to cover a surprise car repair or medical bill. And the math here is it's incredibly simple, but it's so powerful. Chasing a potential 8 to 10% gain in the stock market while you are paying a guaranteed 20% or more to a credit card company, well, that's like trying to fill a bucket that has a giant hole in the bottom. Paying off that debt gives you a guaranteed return that no investment on earth can match. You have to build the foundation first. Okay, so once that foundation is solid, then we can move on to the core investment strategy. And, the truth is, for the vast majority of people, the simplest approach has also proven to be the most effective one over the long run. At the heart of this simple strategy is the index fund. It is basically the exact opposite of betting on a single company. With one single purchase, you're buying a tiny piece of the entire market, hundreds, sometimes thousands of companies. This gives you instant diversification for a really, really low fee, mainly because it's all automated. There's no expensive fund manager trying to pick winners and losers. And the how is just as simple. It's a technique called dollar cost averaging. All it means is you invest a fixed amount of money, let's say $250 on a regular schedule, like every single month. When the market is up, that $250 buys you fewer shares. But when the market dips, that same $250 buys you more shares. It's a beautifully simple system that automates your investing and takes the emotion completely out of the equation. So, why is this so critical? Well, over the last 60 years or so, inflation has averaged around 3.8%. That's just steadily eating away at the value of your cash. But in that same time period, the stock market has returned an average of 8 to 10%. That gap, the difference between those two numbers, that is where real wealth is built. And check this out, this is a really powerful piece of data. Despite all the crashes, all the panics, all the recessions, an investment in a broad S&P 500 index fund has never lost money over any 20-year period in history. That just shows you the power of time in the market, not timing the market. And that brings us perfectly to the opposite approach, trying to time the market. Let's actually look at the data and see why this is just so dangerous for most of us. This quote just gets right to the heart of how our brains are wired. We're designed to take what's happening right now and just assume it's going to keep happening forever. When the market's high, we feel like it can only go up. When it's falling, we panic and think it's heading to zero. We're just not built to see the turning points coming. The numbers on market timing are they're staggering. Over the last 30 years, if you tried to jump in and out of the market and you missed just the 10 best trading days, that's it, just 10 days, your potential returns would have been cut by more than half. The cost of sitting on the sidelines, even for a little while, is often way, way higher than the risk of just staying invested through the dips. So, if market timing usually fails, what about other strategies? Like picking individual stocks or diving into some of those more speculative assets we hear about. Let's compare those to the diversified approach we've been talking about. This table really lays out the trade-offs pretty clearly. On one end, you've got index funds, which offer high diversification with historically lower risk, and you don't need to be an expert. But as you move down the line to individual stocks or speculative assets, that diversification just vanishes. The required knowledge and the historical risk, they both go way up. The data really points towards the most balanced approach for the average person. Now, speaking of risk, a lot of people think of bonds as the ultimate safe investment. But it's really crucial to understand how they work, especially in today's world. There's this inverse relationship. When interest rates in the broader economy go up, the actual market value of your existing lower interest rate bonds goes down. And why is that? Well, it's because new bonds are being sold with a higher payout, which makes your old ones look less attractive. So in a rising rate environment, holding long-term bonds can actually mean losing money. Okay, so we've covered the foundation, the core strategy, and some of the common mistakes to avoid. Now, let's just pull it all together into a simple, actionable framework you can use. So here it is, the whole framework. First, build that solid foundation. Get rid of high-interest debt and get that emergency fund in place. Second, automate your investing using dollar-cost averaging so it happens consistently. And third, focus that investing on broad, low-cost index funds to get instant diversification. The final piece, though, isn't really a step. It's a mindset. You have to be patient and disciplined. Let time and compounding do all the heavy lifting for you. And we'll just end on this question. In a world that always seems to reward complexity, it can be really hard to believe that the winning strategy is just to diversify, keep buying consistently, and not panic when things get rocky. But decades of evidence all suggest that for building long-term wealth, simplicity isn't just effective, it's probably your greatest advantage.